A lot of emerging markets have been forced to hike rates because of the US dollar and the strength that the dollar has shown in the wake of inflation problems and rates, that issue in the US. What's your own sense on where does the story go? How strong does the dollar get and how big a risk is it for EM assets, dollar denominated?
Yeah, I mean, our view has been pretty consistent. We're still of the view that the dollar can continue to strengthen. It's been a little bit of volatility recently, but I think there's a few factors in place here for the dollar. Clear one is that the Fed is still leading in terms of the charge ahead in terms of normalizing rates. We've had a lot of rhetoric from the Fed officials, which suggests that they will continue to do 75 basis points. Our view at Nomura is that we do see the terminal rate far higher than what the market's pricing. We're looking at March next year to be around 5.25 to 5.5%. Market is way away. Market's around 4.5+%. So I think there's still a huge amount of potential repricing that can come through will add to the dollar bid. But let's not just look at the dollar. I think just on the other side, there's clearly a lot of pressures on the European front. UK under significant balance of payments pressures. Europe still running into this winter period with this energy crisis going on, risks around Russia. Asia, as you mentioned, a lot of central banks looking like they're under pressure to potentially take more actions elsewhere where they're hiking rates. Asian currencies facing a lot of pressures, reserve drainage, more currency flexibility. So you add all these factors together, it looks like to me that the outlook for the dollar is still a strength in the coming months.
What convinces you that the Fed would go that aggressive to go to a terminal rate of 5.25, 5.5% by March of next year? Because while you're saying the consensus is more around 4.5%, we had Professor Jeremy Siegel, and his comments have gone viral. Everybody's seen the comments on Twitter. Speaking to, of course, our CNBC US colleagues, he's saying, listen, 3.5%, 4% pause, wait and watch. Wouldn't that take the steam off a bit, cool off the dollar?
Yeah, I think the underlying issue that we've seen not only in the data but from the Fed rhetoric is that inflation momentum is still strong. Underlying inflation risk is still there. It does feel like the Fed does not want to change their views around the inflation outlook. It's just still very high, still uncomfortably high. It's something that they have to continue to target. And the rhetoric from the Fed recently has been suggesting that, don't think about us cutting rates in 2023. It's come pretty consistently from a lot of Fed officials. So I think the risk that we have ahead is that inflation probably is going to be still very sticky to the top side. And this is something that will maintain the current pace of hikes, at least into the next meeting. But then, of course, there may be an incremental slowdown in the coming meetings, but it's going to be very marginal. It's still going to be a few 50 basis points to come out. And that will quite quickly lift us towards the kind of 5% region as we move into next year. So I think that's the underlying problem. It's, growth is still holding up relatively well. Labor market is still quite strong, but inflation is still extremely sticky to the top side.